All right, after a quiet start to the week, markets finally cracked under pressure today. The S&P 500 dropped over 1.5%. The Dow Jones tumbled more than 800 points. Small caps were hit the hardest, down nearly 3%. So what triggered this sell-off? There was a massive spike in Treasury yields. The 10-year yield jumped over 11 basis points up to over 4.5%. The 30-year yield pushed past 5% for the first time in over a year. That sharp move rattled interest rate sensitive areas like real estate and utilities and financials. Meanwhile, volatility exploded. The VIX surged over 15% today, and even traditionally defensive areas couldn't hold positive gains for the day. But not all assets sold off, as we've seen the last few days. Gold, silver, Bitcoin all rallied again today, giving us important clues about where investors are turning for protection. In today's market outlook, we'll break down all the macro catalysts behind the move, some key intermarket charts, the sector rotation that's been unfolding beneath the surface for the past week, and then we'll do a bearish trade idea on Reddit, a stock that's starting to roll over technically again on a new leg lower to the downside on this current bearish trend. So let's go ahead and get started. Today is Wednesday, May 21st, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades. We also put on today's Market Outlook trade before the market closes. Here it's at 3:30 Eastern Time. You can also come up here and click on Live Trade Review to get to the same class. You can sign up for our daily Market Outlook email here by filling out this form and clicking on Sign Up. Come down to the bottom. You can also see a written kind of summary of what happened in the markets today. If you come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon here. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the obviously with our down day today, it produced a bearish short-term pattern on the market forecast chart, the near-term line dropping into bearish territory. It's done this before, just did this a couple weeks ago, so this isn't anything new. The difference though this time versus last time is this time on the same day that we're crossing 40 is the day that the momentum line dropped to oversold levels. And at one point in time, as you can see, when we were at the lows of the day today, where does that be? That would be 58. When we were closing at the lows of the day, the momentum line was extremely low, as you can see there, and the near-term line was at 30.7. So fortunately, we didn't finish there, and so we kind of just a little bit of jump off the low, which is about 14 points off the low point. Kept the short-term sentiment from being even more bearish than it could have been. I mean, that would have been really bad if just a 14-point drop. That's enough of some bullish sentiment from this chart's perspective to be like, okay, like this is a bullish intermediate confirmation signal. The intermediate line above 80, the momentum line below 20, the near-term line in bearish territory, but not below the 20th percentile. Like this in and of itself would be considered a buy the dip signal. We'd jump off this back up to the upside. Again, but keep in mind that the near-term line did cross 60 and 40 on the same day. And on that same day, the momentum line dropped to oversold levels, pretty deep oversold levels, well below the near-term line, suggesting that the near-term line probably will drop to oversold levels tomorrow, barring a significant increase in risk appetite tomorrow. So we are dropping below 5%. We've been above 5%. We are dropping below 5% above the 30-day moving average. If you were to look back at the last four instances in early 2023, and then 3 times in 2022, and then here in 2020, September of 2020, these are 1, 2, 3, 4, 5 times that we were above 5% above the 30-day moving average and came back below it. they all produce intermediate decline. So you can see this one there, that one there, and then these two legs lower on the correction, and then of course this intermediate decline in 2020 that ended up going into the election there, and even this very first one in 2020 produced a bull tag. So it didn't produce an intermediate decline, but it did get down. It did push things down to the moving average there. So based off of that precedent, there's a pretty decent probability that we might be forming an intermediate decline now. So there's different stages. We talked about this in my technical analysis class today. There's different stages to these short-term declines and how they could turn into an actual bearish, like a dark pink shading and a red line. And right now we're at that first stage, right? The bullish intermediate confirmation signal. And we'll know really, really quickly, like by tomorrow, if we're going to bounce off of this. Because if they both end up dropping, just like this one here, right? Over here, you had a strong intermediate posture. The near-term line dropped below 60 and 40, the bearish levels, but not into the lower reversal zone. In this case, the momentum line did drop to extreme lows because we did finish at the lows. We did actually finish slightly below the moving average as well. But that was a pretty significant down day, and that ultimately led this. You can see the next day, instead of bouncing up, the momentum line stayed extremely low, and the near-term line followed suit, and then that started the intermediate decline. So that's what we're going to be watching to avoid tomorrow. We want to see, we don't want to see another down day here. We want to see a rebound in risk appetite, and this pattern suggests that there will be until it doesn't, right? Until there is not one. This pattern here is a nice, good, bullish buy the dip signal. And so we can anticipate a bounce until we don't. Until we keep, if we go lower, then now the next stage, right, will be the bull tag stage, that we'd ultimately get to. Obviously, probably won't produce a bull tag tomorrow, but we would be likely to get to that stage like we did here. It only took 2 days here to get to the bull tag, but we would be likely to get to that stage if we don't bounce off of this here tomorrow on the S&P 500. If you look at the NASDAQ 100, you can see again very similar pattern. Let me get back to a 1-year chart, but not as bearish, right? This is a very typical bullish intermediate confirmation signal. You're below 20, but not very oversold. You're below 50 on the near-term line, so a good opportunity here for a bounce off of this trade. The only thing that'd be a little bit of like, maybe this one won't bounce is because we are so high above, 6%, almost 7% above the moving average. When you're already that high, as you can see, it's an 82nd percentile. It's hard to maintain that such strong level. So even any near-term bounce we get off of this probably won't last very long, even if we do get one. If you take a look at the Dow Jones Industrial Average, you can see it pop down the near-term line. In the momentum line dropping to oversold levels, almost extreme. The near-term line almost in the bearish territory, so it looks very similar. And then finally, your Russell 2000, again, extreme lows on the momentum line, near-term line dropping below 40, intermediate line still. So all of them showing intermediate confirmation signals, but they're pretty strong. So while we may expect that this signal will bounce up, we do need to be aware it's probably lower odds than normal because of how bearish these lines are today and the patterns that we're seeing there. A couple of stocks in the news. A couple of stocks that were news say Target. Target had its earnings released overnight, and you can see it was down today, producing its own bull tag. You can see it drop down below its moving average, a pretty sharp move down towards its 52-week lows. The near-term line crossing below its intermediate line. The intermediate line turning back down, hence the pink shading, and being below rising moving average gives you a yellow line. So there we go. There's your bull tag there. So that's an issue. United Healthcare continues to be in the news itself. It's kind of in a dead cat bounce type pattern where you did have a bounce. You had the big drop, over this past week or options expiration. But then on Friday before and then Monday after, we had a nice good rally. The near-term line jumping up to high levels. But just like that, I mean, it's not been strong enough to get the intermediate line, and just like that, the near-term line's already back down. So it looks like there's probably a pretty decent likelihood we retest these lows on some kind of like dead cat bounce type trade on UNH. Bitcoin got some good news from the administration. Looking like we might be providing some good regulatory framework for Bitcoin with the Genius Act. And you can see it continued higher, up above almost 109,000, getting up to 108,000 yesterday. Strong bullish posture still, rising market sentiment line, near-term line still on the same near-term rally, so that's looking good there too. And then finally, GM was also in the news with export, it's halting exports to China, and that had a negative impact, down 1 2/3%. Similar, like the near-term line crossed below 60 and 50, but not below 40 like the markets, but the momentum line dropping to extreme low. So technically this is a buy the dip signal, but like the markets, considering how deep the momentum line is, probably lower odds than normal that we'll get a that will bounce off of this. And if we don't, then we're probably headed towards a bull tag, at the very least a bull tag that would either start a bearish decline or provide a bounce opportunity to a new leg higher on this current intermediate run that it's on. Let's take a look now at the weekly chart for the S&P 500. And again, you can see, remember, we did hit a higher high, so we have a higher high this week, about 10 points higher. The Hakinyashi close is also higher by about 10 points or so. So higher high, higher Hakinyashi close. But like right now, we're trading at 40 points below this week's Hakinyashi close. And you can see the midpoint's going to be right around 58.05. We're above that by about 40 points. But you can see now, we're setting ourselves up for a transition candle. As of right now, there's 2 more days left in the week, and we'll see how things. But as of right now, we're setting ourselves up for a potential transition candle next week. And again, whether that ends up being a bearish candle, then that transition would transition into a reversal. Otherwise, it would be more of a continuation type pattern there. The size of the candle, you can see, is dropping below its moving average, and that's a typical sign of weakness after you've been so strong for the past so many weeks. If you take a look at the 3 green arrow charts, there's still 3 green arrows. The only red arrow we got today was on the small cap index, but everything else is pretty close. The MACD typically is the first red arrow on that. Your stochastics will be most likely the second one, which may align with if we get to the 3 red arrow signal, right? Because that's the next layer. If we don't get the intermediate confirmation signal to bounce, then the next stop would be the 3 red arrow signal. And we'll see if that ends up being the case here. We'll find out, again, like I said, really soon. Looking at the 2-line version of this chart, we are below the 8-day moving average. The MACD, like I said, is very close to crossing below its moving average. Stochastics is dropping. We did have some pretty decent volume. So if that's the first time we've had some pretty decent volume here in a while. Looking at some of these other oscillators, if you look at the DMI, we are now no longer above 30 on the positive indicator. We're above 20 now on the negative indicator. So, again, still bullish, but not as bullish as it was. The RSI, same thing. We're still above 50, but we're not above 60 anymore. So I can still actually draw this green going to today. So we're not above 60 anymore, but we are still above 50, so I can't stop the green box, right? That doesn't stop until we cross below 50. We're still above 0, but we're not above 100 anymore on the CCI. So kind of a common theme here. We're bullish. We're still bullish, but it's not we don't have the trending signals. And we're still above the green line here, and we're way above the blue line, and that blue line is not going to change here for a while. The rate of change is still very positive. The trend is still mature. We're not at risk of breaking the trend. We have to really drop at least, it's most of the time drop below the blue line, but at least work our way down there before this, mature trend drops to 0. So we're still okay there. We're still very green on the cloud, and we're still way above the cloud. So one day doesn't change necessarily that, just how bullish we were. We are obviously not in the upper quartile anymore of the Bollinger bandwidth. That is falling. But we're also not in the lower half of the bandwidth either. So it's, again, kind of the same thing. We're still bullish. We're just not trending anymore. We're just, a little bit. We're below the Keltner channel. When you've been above the Keltner channel, you get below it. It's a sign of weakness, but especially with falling momentum. But it's still very, very strong bullish momentum. The bands are still way outside the Keltner channels. So we're not in the lower half of the chart. So we're still okay. It's just a small little bout of weakness. We've been shifting towards defensive sectors for the past however many days. And, we can see today, what ended up happening. Like this was to be expected based off what we've been seeing from a sector rotation standpoint over the last, 4 trading sessions going into today. Let's take a look at the intraday chart. If you take a look at the intraday chart, again, lower high and a lower low. We closed below. Remember I told you a few days ago, like last week even, that we were very top heavy, with the point of control being so high over here. Well, again, that made us susceptible to a drop. Like if we were to drop into this area, you can see how fast it can go because there's just no support there. And that, we are still way off of last week's low. But if we were to get below last week's low, like IWM already has, then it takes away. Now IWM didn't have the same breakaway gap that we had. See SPY, you can see we had this gap from last Monday, but that gap, if you recall, got us above the 200-day moving average. We gapped above the 200-day, and we gapped above the post pullback bounce high point, like this failed pullback bounce high. We got above that. So it was a breakaway gap, and so far we're not threatening that. If we were to threaten that and fill it in, now we're going to be, especially with the channel starting to decrease, we're going to start to move, into lower levels here. And if we, considering how, you look at the 20-day average for where we've been trading relative to the 4-week range, we've been up so high for so long that now the 4-week average is above 90, and it hasn't done that since over here. In October of 2024, when we were just above 90 for a very, very long time. So it's brought that up very high, but now we've got the crossover and we're outside, we're below 80. Now we can get below 80 and bounce right back up, but we need to bounce right back up because if we keep going down, especially towards bearish levels, then now we're susceptible. This isn't just an intermediate confirmation signal bounce that we should find out tomorrow, at the very latest Friday, if it's going to be that. Because if it's not, then now we're looking at this falling down towards 50 and maybe 40. And then, does it get into the lower reversal zone or not? That's going to be the issue, what we'd be watching for. I told you that the trading, volume picked up, but you notice the trading range also picked up. Finally, this is the first day in a while that we've been above the average. We've been below the average. The average has been falling. We were above the average on the volume too. So as a result, when you look at it in context, the decline in the ATR slowed down today. It's still above the 1.5%, but it kind of slowed down. The volume bottomed out as well. It has been bottoming out for a while, but we were at 95 million shares. We were at 10 points on the range. We've been so low previously, especially after the gap. So we'll see if if we were to if we're gonna bounce up on the intermediate confirmation signal, it's gonna be with very small ranges. It's not gonna bounce up 20 points, in a couple of days. It's going to bounce up 10 points probably over the course of 2 or 3 days, and that's going to be fine because we're above moving averages, and when you're above moving averages, the ranges just get smaller and smaller until they get below 1%, and you're in trending levels. That's okay. That's the point. We want them. We want the ranges to get above moving averages and to get smaller, because when they get bigger, like we saw today, that's not a good thing. It's not what we want to see. And then finally, if you take a look at the VIX, we've been talking about this this correlation turning less and less positive between the VIX and the VVIX, the volatility of the VIX. Well, it dropped below 50% today. It got all the way down to 40%. It was actually at 30% at one point. The VVIX jumping up to 106. The VIX itself jumping back above 20, jumping back above 90%. So again, very temporary. So far, very temporary. It's also jumped back above its 200-day moving average. So one day, again, we'll see. You can see right there. One day doesn't necessarily mean that we've turned around, but as I mentioned to you before, when the VVIX drops as far and as fast as it did, that typically precedes a jump in volatility. When the correlation between the VVIX and the VIX drops as much as it has, that typically precedes a jump in volatility. That may not happen. This might not be. We might fall back down tomorrow in volatility. It might still be like a week away from that jump in volatility. But we've been so complacent and we've been so low, and the VIX have been rising. You can see here if I zoom in, from May the 12th, you can see how much the VIX has risen, whereas the volatility index hasn't really gone anywhere until today, right? And so that's why the correlation has dropped as much as it has. So when the VIX starts to jump ahead of the VIX, it generally means that the VIX is coming afterwards. All right, now let's take a look at what's driving this price action here today. And obviously today the big driver was the rise in bond yields. If you take a look at this chart for just today, bond yield, like the TLT was down over 1.5%, 1 2/3%, kind of matching the S&P there. The Q's down almost 1.5%. IWM down almost 3%. So big time move here. If you take a look at the ratio chart of the Q's relative to IWM, I'll pull this up here. Big jump to the upside. Look at that. Well above 2.5. This is the highest it's ever closed at, the ratio of the Q's relative to IWM. Remember, it got right around 2.5, a little bit below 2.5 in 1999 at its peak. Big move up here. And you can see that reflected here. Just how big of a drop. Real estate down as well. I mean, interest rate sensitive areas all just struggling today. But other areas too. You can see equities were all down. Emerging markets, developed markets were all down. Though they outperformed with weakness in the dollar. It didn't help them rally, but they outperformed with the weakness in the dollar. The dollar continues to be really weak. If I take a look at the dollar index, you can see back below moving averages, and MACD and stochastics rolling over to bearish levels. And you can see the 10-year yield jumping up 11.5 basis points today, closing at 4.596. So that's just above this high point at 4.592 for the first time. So 11.5 points, basis points. Obviously, the trend is still bullish. You can see that in this market forecast as well. The trend is, that's the biggest driver on what happened. I mean, there's some other news about the budget plan, whether or not it's going to get passed today. UK and EU putting sanctions on Russia from a international equity standpoint, having a little bit of an impact as developed markets lagged behind a little bit on emerging markets, but developed markets continue to outpace. Here, let's go back to here. Developed markets continue, and we looked at this last night. If developed markets continue to outpace the S&P, as you can see, a big jump today. This is typically a negative correlation between that. So it's not necessarily something we want to see. As you can see during this correction, it really took off above the 200-day moving average there. If I were to go back to the 10-year chart, the S&P had been killing developed markets, but during corrections, you can see the rallies it can have, and right now we're having that rally as it's typically below zero on the correlation. Sometimes it will rotate to the upside, but it's not too common. It doesn't stay there for very long before rolling back down. So you see that as well. Bonds underperforming, gold still continuing to move higher. So in terms of like the biggest winners today continue to be these precious metals, as gold is up, silver is up, still making another run up there. Bitcoin, it's not precious metal, but it's it had a good day today as well. So still a lot of money moving, towards really the ultimate state. I mean, anything physical, even agricultural commodities had an up day today. Crude oil did not. Crude oil suffered a little bit there on the prospects of first of all, it rallied on rumors that there was going to be some kind of actions by Israel over Iran. Then those kind of simmered down, and then you had inventories jumping up, and that really brought crude oil way off of its highs. At one point in time, well over 2% gain for the evening last night, but then finishing the day, the period, down 0.5%. So pretty significant move there. And again, this would be more a reflection of, again, growth prospects, because, economic growth requires it. It requires energy and utilities, and especially now utilities with electricity fueling the AI move. But, you got to get that electricity from somewhere. And And so, energy as a whole still is a, very big component of, a booming or growing economy. And, it's been below its 200-day moving average for most of the past year. It's been below it for much of this calendar year. And then we see today, looking with that long upper shadow and then the bearish candle back below moving averages. There's the idea that, it's likely that, and in fact, it's the first day below the 17-day moving average since we've had this little bullish momentum run. So looking like there's a chance we might start to have a little bit of a rollover on that. Again, would be considered more of a kind of a risk asset class. Not surprising me, everything went down today. So not surprising to see a big change in the McClellan oscillator. So we went from being above zero at positive 24.5 to being at minus 21 3/4. So big change there. But again, we're not below minus 35, so not a big move, to the downside. And sometimes, you might be flirting with, with this, again, that last drop I shared with you, February, when we dropped down on that Friday before expiration. We had that big drop there. We were also only about minus 27, so we weren't below the minus 35 yet. Though there we were already weak before coming into this. So pretty significant move from that perspective. Also, you won't be surprised to see that the number of stocks above the 50-day moving average dropped down. So we were close to 400. We're back below 350. That's the 70% mark. 400 would be the 80% mark. So right around 375 would be that 75%. So we're not there. We're not as bullish, but still way above the average at 287. The number of stocks above the 200-day would have come down a little bit slower, but it did come down. It's sitting right on the average. In fact, it's sitting right on 250, but still above its average as well. The number of new highs today, let's see, that's the net new highs. Let's look at the regular new highs first. Just on the New York Stock Exchange, it fell to only 54, but still, sitting right around its average. And then finally, the net new highs and new lows turned slightly negative, but again, not back below the minus 100 level yet. So again, kind of following this familiar theme of we're just not bullish in it. All these indicators are not bearish, but they're also not bullish. And they're still bullish enough to maintain the trend we have, but not bullish to elongate and perpetuate the trend. As you can see, we're getting a red tag here on the zigzag chart. An orange tag, so we're down 2%. A red tag would come up if we were to drop the full 5%. But we are down 2% now off of this. After a 15% run to the upside, after 9.5% move in one day, and then we fell 5%, 5.5%, and then we've rallied 15.5%. So it's been a good run. We're down 2%, and we'll see if that continues. In fact, if you look at just from a Fibonacci retracement standpoint, here from that low up to this high, we're still way above the 23% mark. Remember, a retracement doesn't start until you break the 23% line. So this is the run we've been on. It doesn't start until we break that level, which would also happen to be the failed pullback bounce high point. So if we stay there, if we pull back to there and we bounce, great. We get that intermediate confirmation signal working out in our favor. We continue to push this green tag higher. But if we start to break down to that 38% line, now you can see, that would be a red tag at that point. And we'd be looking at, a bull tag on the market forecast chart, as well as 3 green arrows. Let's see here, divided by this high point is 59, 68, 61. So yeah, you'd be at a 5.5% drop if we could get to the 38% level. That would be a red tag, but it most likely would also be a bull tag on the market forecast and 3 red arrows. And at that point, we'd be looking for support to hold and a bounce off of that, back above the 23% line, and then a new green tag with double digits in it. A double-digit green tag off of that mark would now barely get us above the up to new highs. So that would be kind of our more ideal scenario. Instead of dragging this green tag out, to where, it's probably going to be close to 20% by the time we get up there, and starting to see signs of exhaustion, and we'd be susceptible to like a fake out pattern. So instead of that, we can get a little pullback, build up some more juice, and then get a double-digit green tag, a 10% move just to get to new highs, and then anything above and beyond that would get us up and through that, and that would be great, right? That would be kind of what I think we're all looking for there. Let's take a quick look at the sector rotation. I've been sharing with you like the last 4 days, right? The sector rotation for the last 4 days has been really defensive oriented. Well, it was that case again today. Now everything fell today. Whoops. Everything fell today, but your defensive area still held up. Staples held up okay. Communication services, remember, it does have a defensive element to it. Though most of that gain, if you look at the Mag 7 names, because when you're looking at those three sectors, you want to look at the Mag 7 names. The biggest names in that space is Meta. Meta was down 0.25%, and then Netflix was up. Was up 0.25%. Google also. Google was the big winner and was a big reason why XLC was up as much as it was. But remember, it also has a relatively safe haven component to it as well. It's just very, very small, because the stocks that are not Netflix and Disney and Google in that space, or Meta in that space, are just really, really small on a relative basis. So it did okay. Materials, you can see, doing well too. But interest rate sensitive utilities were down with technology, energy, discretionary is down with real estate, healthcare is down. So, everything felt the brunt of today's selling. So it was kind of a full-on risk-off kind of a day, whereas we had been previously just kind of rotating into safety, but still maintaining, small, slight bullishness here. But that faded today, right? So today we've now gone negative on the S&P, and we're still way outperforming on the safety trade basis. But you saw today, like, everything was down today. That brings us to our trade idea of the day, which is actually on Reddit. Reddit's a recent. It doesn't have a whole lot of history. It's like a relatively recent IPO that we had. In fact, let's see, when did it actually come on here? Let's see if I can get my cursor. There we go. Finally. So I get started back here in March of 2024. So just over a year old. This stock has been, and so you can see, in fact, the market forecast chart didn't even start on this until August of last year. So it takes some time to get going, but you got some time now, and you can see the intermediate line had been on a bullish when we were bearish, everything, right, along with everything else, and it rebounded. Just didn't rebound nearly as strongly as what we saw in the S&P 500. You got the bear tag. We built on a little bit, but kind of stalled. Got a bull tag here a couple of days ago, and now we've broken below all these lows, below the moving average. The intermediate line's out of bullish territory, never did get in the reversal zone. Short-term sentiment's bearish. Market sentiment still down there at low levels. If you take a look at the weekly chart, we've been in this death cross the last few weeks, and now it looks like we're persisting in that with a pretty bearish candle this week, and the PPO falling there. If you look at the 3 green arrow chart, obviously we currently have 3 red arrows on the stock, and today's move generated well above average volume. If you look at the 2-line version of this chart, you see that we are back below the moving averages. We're still below the 200-day, and now we're below the point of control again, and dropping MACD and stochastics, dropping the bearish levels. If we take a look at all these other oscillators, you can see the DMI is also showing us a bearish crossover, and now we're not below 20 yet on the positive, so the ADX is actually still pretty low. So we're actually still not even in a trending state yet, as much as we've already moved to the downside here. The RSI and CCI, the RSI is below 40, the CCI is well below 100, so below 150, so pretty bearish levels. Looking at the Ichimoku cloud, we are back below the cloud again. The green, below both the green and blue lines. Again, we're still in this kind of trend ready state, and we're not trending yet because we don't even, we're below 0, but we're not below -1. We're not above 50 yet. That's what starts the weak trends, right? That's, you have to get through those levels to be trending at all, and even there, it'd be a weak trending level. If you look at the Bollinger Bands and the Keltner channels, obviously we are below the lower band. The bandwidth has really come down inside the Keltner channels, but today kind of breaking out, below the, moving away from the point of control towards the downside of the value area with some increasingly bearish momentum. So what I decided to do there was to do a long put vertical spread. If I can get to it, here we go. Long put vertical spread, selling the low 20 delta, 25 delta in this case, buying the 90 for some protection. So you see it gives us about, when we position size for 500 bucks like we typically do, it gives us about a 2-to-1 reward to risk ratio here. It's not too bad. With a little bit of wiggle room as well for to give us some timing, right? For in case it does rebound up a little bit here, that would be okay with us. So that's our trade idea for today. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody. We'll see you all tomorrow.